Hey there, welcome to BuyCaps Business India. C. Angat Pal Singh, and a special warm welcome to my NRI viewers. Now, this is my third video on the same topic. NRI selling property in India can save TDS. Every time I try to bring one or two additional aspects to this particular topic and also try to make the video a little crisp as per the emerging trends. So, let's dive into the topic straight away. As an NRI, if you are selling a property in India, so is there any tax payable on the transaction? The answer is yes. There is a tax payable on the capital gain that arises in that transaction. So what is the capital gain? Capital gain is basically the profit that you earn on this particular transaction. The profit is as simple as that: sales minus cost. You bought a property for X price, you sold it for Y, so the profit is Y minus X. There are two types of capital gains. One is long-term capital gain and what is short-term capital gain. Long-term capital gain arises when you have actually held the property for more than 2 years, and short-term capital gain arises when you held the property for less than 2 years. So why is there this distinction between long-term capital gain and short-term capital gain? Basically, we call it LTCG and STCG. Why is there such a distinction? So basically, if it is an LTCG, there are three benefits available in the law. First is that there is a lower tax rate in LTCG. On long-term capital gain, you pay a 20% tax plus surcharge and education cess. On short-term capital gain, you pay a 30% tax plus surcharge and education cess. So when I say 30%, it means the highest tax rate, because the tax is payable on short-term capital gain on slabs basis, but since the gains on the properties are mostly higher, so highest tax rate is taken for that purpose. So for first benefit of LTCG over STCG is that the tax rate is lower. Second benefit is even the taxable amount is lower. How? Because when you calculate the capital gain in case of LTCG, the cost is taken at a higher price, at an indexed price. Indexation is basically done on based on the various indexes that the government has prescribed for various years. I'll quickly explain it later in the video. So the taxable value gets reduced because the cost is higher. So lower tax rate, lower taxable value. And the third benefit is you can save the entire tax on the capital gain if it is a long-term capital gain by investing the amount further in another residential house property or in the infrastructure bonds. So there are deductions available in section 54, 54F, 54EC, but only applicable if it is a long-term capital gain. So there are three benefits if it is a long-term capital gain, not a short-term capital gain. Now it is about LTCG and STCG. Now the next question comes, how is this tax paid to the government? So normally what should happen? Like, I am a resident in India, I should sell a property, receive the proceeds, calculate my tax and pay it to the government. If I don't do it, the government has various means and measures. They can issue me the notice. They can actually initiate prosecution proceedings against me if I do not pay the tax. I try to avoid the tax. They can even attach my property, my bank balances here. So it is very easy for them to recover the tax from me because I am here, my assets are here, my estate, my bank accounts, everything is here in India itself. But in case of NRIs, it can be tough for the government to recover the tax if NRI does not pay it by himself, because ultimately the NRIs are staying outside there. Most of the estates are located outside. It's not necessary that they have any assets in India. So the government might not be able to attach any assets to recover the tax. So the government has this apprehension that NRIs might avoid tax. So what does the government do for that? So the government puts the liability on the buyer of the property who is buying that property from the NRI seller to deduct the tax and pay it to the government. Deduct from the sale proceeds that are being paid to the NRI seller, of course, and pay it to the government, and pay only the balance to the NRI seller. So let's say you are selling a property for rupees 5 crores. The buyer will deduct the tax, deposit it to the government, reduce it from 5 crores and pay the balance amount to you. Till now it seems fair because you might think that ultimately the tax is to be paid. If I pay myself or if the buyer pays on my behalf, how does that matter? Actually, it matters a lot. Let me explain you how, and it is a big trouble. Basically, the buyer is supposedly not supposed to know your gain or the costs. So the buyer is liable to deduct TDS on the entire sale consideration and not on the capital gain portion. So let's say you're selling the property for rupees 5 crores. It's an LTCG. So the buyer will deduct 20% on 1 crore rupees. Sorry, on 5 crore rupees, which comes out to rupees 1 crores. Now let's say you bought this property for 1.8 crores in 2011-12, financial year 2011-12. You're selling it that property in March 2024. So the indexed cost comes out to roughly 3.5 crores. So cost is 3.5 crores, selling price is 5 crores, the profit is 1.5 crore. Your actual tax is 20% of 1.5 crores, that is 30 lakh rupees. But the buyer will deduct 1 crore rupees on the entire 5 crores, deposit it to the government and pay you only 4 crore rupees. Now what happens? There is an excess amount of TDS that is deducted to the tune of 70 lakh rupees. So basically the NRI has to file his tax return in the next financial year and claim that 70 lakh back from the government. Now you would think that, okay, ultimately the excess amount deducted is getting refunded back. So how does that matter? Actually, it matters a lot. It gives you two kinds of losses. First is your money gets stuck for 1.5 years, because let's say you're selling a property today in April 2024. You cannot file your tax return relating to this transaction before April 2025. So another 2, 3, or even 4, 5, 6 months the government can take actually to process the return and issue you the refund. So your money gets stuck, your consumption of that money, your actually enjoyment of that money gets delayed by 1.5 years. And second loss is that since the rate of the foreign currency increases over time, like US dollar, it keeps on increasing. So if you are living in United States, so after 1.5 years, if the US dollar rate has increased, you ultimately end up getting lesser dollars in future. So these are the two kinds of losses if this money gets stuck and the excess TDS is deducted. So is there a mechanism to actually avoid this excess deduction? The answer is again, fortunately, yes. It is called the lower deduction certificate, the LDC. So I've been talking about LDC a lot in my prior videos as well. And I've been doing LDC a lot for NRIs, and it is a very beneficial mechanism. So listen very carefully. It is very simple. Once you have actually concluded an agreement to sell with a buyer, and there is a registry date fixed, 30 days, 45 days, or 60 days after your agreement, you can actually apply to the tax officer in form 13 for issuance of a lower deduction certificate. In that application, you give the entire calculation of your capital gain along with the supporting documents. The assessing officer scrutinizes those documents, issues additional clarification letter if required, or additional documents that he wants to see. And once he's satisfied, which he ultimately gets satisfied because you have got all the documents, and he issues a lower deduction certificate based on the actual capital gain. So in this transaction, let's say 5 crores property, 3.5 crores indexed cost, 1.5 crores profit. So the tax that is actually payable on this transaction is 30 lakh rupees, on 20% on 1.5 CR. So the tax officer will issue a certificate to the buyer instructing him to deduct 6% tax. So that is 30 lakhs upon 5 crores, 6% tax instead of 20%. So this is how your money will get saved. Now the buyer has the certificate from the tax officer, so he will not be penalized for deducting a lower tax, and ultimately your money doesn't get stuck. And the purpose of the revenue of the government also gets saved because the tax gets recovered very easily. Now, this is about the LDC. Additional one or two aspects. So what happens after the sale transaction? The TDS gets deducted and you get the money in your account. So you can freely repatriate that money up to $1 million per year, 1 million US dollars per year to your foreign account. So that is a limit placed in the Foreign Exchange Management Act of the India. And for doing that, you need to fill, certain forms. One form is 15 CA and a CA certificate called 15 CB, which you give to the bank, and the bank does that remittance to your foreign account for you. The second aspect is the foreign tax credit. Now, let's say you are a US citizen, you sold a property in India, the Indian government took the tax on it. The US government will say that since you are our citizen, so if you have got income in any part of the world, we will tax you. So the US government will also seek tax on that particular transaction. So do you have to pay double tax? Fortunately, no. While calculating your tax in the United States, you will get credit of the tax paid in India. So you have to actually furnish the proofs of payment of tax in India, and then you get the foreign tax credit in the United States. So you only pay any additional amount that is calculated on that particular sale transaction, because the tax rates can be different in both the countries. So this is about foreign tax credit. And last but not the least, if you have actually furnished all the documents to the tax officer, obtained the LDC, got your tax deducted, Now, do you need to file an income tax return? Yes, you need to, because there was a tax payable. Doesn't matter, it was already collected, but a proper calculation and the calculation of tax liability, the manner of discharge of tax liability, all has to be mentioned and furnished in ITR that is to be filed in the next financial year, which is also called technically the assessment year. So this was all about the TDS on the sale of immovable property by NRIs in India. If you have got any queries or clarifications that you require on this particular topic, feel free to comment on this video and I'll be more than happy to answer those. Thank you very much.